Welcome back to another episode of Making Sense with me, John Napolitano. We're here to break down the big questions high net worth families face. You know, the ones your investment guy never talks about. No fluff, no finance 101, just straight talk to help you make smarter decisions and keep your wealth working as hard as you do. Let's get to it. Welcome to another edition of Making Sense. I'm John Napolitano. Today we're going to talk taxes with a self-professed tax nerd. Yep, that's what she does for a living. Not going to chase you around at a party like the Ghostbusters guy and ask who's your accountant, because Nichol focuses on mergers and acquisitions, helping people sell businesses, buy businesses, and the tax aspects thereof. Nichol is with Citrin Cooperman. And Nichol, why don't you give us a little bit of that background. Tell us about what you do at Citrin.
Sure. Thank you, John. Yeah. So I lead the mergers and acquisitions tax practice at Citrin Cooperman. I guess a little bit of background on our firm is that, we specialize in servicing the lower middle market, closely held businesses, owners of those businesses. At times that means high net worth individuals and their families, but particularly in the M&A space. So we see most of our transactions somewhere between 10 million up to a few hundred million of enterprise value. But it's what we've done for 46 years as a firm. It's our bread and butter. Yes, we're a national firm. We have over 3,000 employees, but really bringing service to that lower middle market is what we do best.
So that lower middle market probably covers about, what do you figure, 90% of America's workforce?
I mean, that's probably fair, but I don't know off the top of my head. That's a good question. The chat GPT.
Yeah, definitely. That's an AI question for sure. All right. So when you go in to sell a business, one thing I've observed, a couple things actually. One is people outgrow their accountants, and, their accountant is their buddy from high school or their college roommate or someone they've known for a long time that they obviously trust, who's probably done a decent job for them. But when you get into, a bigger business or you're trying to sell your business, a lot of times that's over the head of the incumbent service providers, particularly on the accounting and probably even the legal side as well. So what I'd like to focus on is, what should these business owners be thinking about before they take the first step to go ahead and sell that business from, maybe even more than a tax perspective, but for sure the taxes are your wheelhouse. So what should they be thinking about?
Yeah, no, it's a really good point because, of course, sometimes they're clients of Citrin already, but so many times they come to us because they have great tax preparers, long-time relationships, but just not that level of, this is an M&A tax advisor, and that's all they do all day, every day, which is what our team does. And the nice thing is, because we're so used to that, we work alongside those advisors, right? So that historical knowledge is really valuable. So it's always nice to say to a client, hey, you don't have to switch accountants. Like, we can work alongside them as part of your deal team, right? But to get to your question, we don't have to switch. We don't have to step on toes. We make a really great team working together. But some things that, I always like to start off considering when someone comes to us and says, hey, I'm thinking about going to market. What should I be thinking of before I do that? Or have we done estate planning, right? So that's a little bit outside of my personal wheelhouse, but let's address that first to see if there's ways we can maximize value for the family, post transaction and beyond. And then, regarding the transaction itself, we always say certainly no such thing as getting us involved too early. As I think you alluded to, certainly could be such a thing as getting us involved too late. But what that could look like is, hey, look, how am I structured today? And, how should I be structured if I'm thinking of going to market? Should I be an LLC? Should I look to have more than one entity, structured? Should I have a holdco in there? What do I do with my S corp? And, and what am I holding, right? So we'll talk a little bit more as we get into various entity types and what that looks like, but really understanding from a tax perspective, what am I and what am I going to be selling, right? And then some other things to think about certainly is diligence, right? What's a buyer going to find when they look at everything? Because a buyer is going to do due diligence. Yes, they'll do financial due diligence. They'll also do tax due diligence. So they're going to look at the last 3 years worth of tax returns that are open under the statute of limitation. So what are they going to find? And again, no offense to anyone. We take certain positions on returns, right, that may not be the most conservative. But when it comes time to go through a transaction, we know buyers going to look at that. Are there corrective measures we can take today before we go to market, that will make it more attractive to a buyer. The buyer's going to say, okay, that's an acceptable position. That's a better tax accounting method, et cetera. And then sometimes just modeling out tax implications. So we have so many folks come to us. I'm going to sell my company. I know it's a 20% tax rate. Well, maybe not. Right. So sure, if I'm selling, C Corp stock, I'm at actually already 23.8% because we've got another net investment income tax in there of 3.8, but also, state and local tax implications. And then is a buyer really going to want to buy your S Corp stock? They're not, right? They're going to want you to do some sort of reorg or treat it as a different type of transaction for tax purposes. And so what does that mean to a seller? So kind of modeling out, what they expect to walk away with, what they hope to walk away with. And then in order to get that amount backing into what type of enterprise value should I be looking for, right? So we're always looking to maximize those net proceeds, net of taxes after the deal. So lots of things we can do pre-offer, pre-engaging an investment banker that are respected by the IRS that we wouldn't be able to do post-offer, post-LOI, and sometimes post, even engaging an investment banker. We want the IRS to respect anything we're doing to restructure estate planning prior to a transaction rather than say, yeah, you just did this in contemplation of a transaction. We don't respect it, and we're just going to step everything together.
So ideally, what would you say the ideal time frame is? I want to sell. How much beforehand should I start this planning?
I would argue to say that at formation. But I'll be real for a moment as well, right? Like, so I'm forming my company. Here's my plan. How should I form? That would be in my opinion, the most ideal time. Should I be an LLC, a partnership, a C Corp, an S Corp? Based on what are the business activities, what state am I operating in, and then how, what's my plan? Am I going to exit in 2, 5, 10 years or never at all? Right. So just something worth mentioning there. But realistically, that's not what happens. And most people say, hey, I'm holding my company. I've run and operated this company for, a couple of years, 5 years, 30 years, 60 years. What should I be thinking of now? We like to say, anywhere from 1 to 2 years out is great. When we have a transaction happen in a tax year, as separate and apart from a tax year where we do estate planning or restructuring, that's always ideal. So as much time that we can create between estate planning and deal. But that depends on the type of restructuring. Like there are times when folks come to us, hey, I've got an offer that I've signed. What do I need to do now? Right. And if there's certain attributes to that transaction, we can still restructure. We do it all the time. We'll talk a little bit more about what we see a lot of right now. But it doesn't mean there's no opportunities. Just to answer your question, it's the earlier the better. So, if we're in there 6 months, 12 months, and again, certainly before they've actually gone to market, that provides the most flexibility for pre-transaction tax planning.
Yeah, I'd like to see at least one full tax year plus ahead of time. So we can, let's say, structure our stuff, make believe it's now in 2025, and you go all through 2026 and you do your deal in 2027. To me, that would be ideal. Now, even if you're lucky enough to get capital gains treatment, add your 23.8 plus your state, depending if you're in New York like you are. I mean, you could end up paying a third of the proceeds of that business back in taxes. I'm not sure a lot of people factor that in their financial planning when they think about, oh, my business is worth $50 million. Well, no, but it's actually worth 35 in your pocket when it's all said and done, maybe less.
Yeah.
Talk to us about some of the common mistakes or the common things that you need to change when you get engaged to help someone on the sale.
Yeah. So, I mean, to your point, we're talking about it, not considering tax early. Now, sometimes we hear, hey, look, I've got this offer. Like I've got a house down in Florida, so I'm going to move before I sell. Too late. There's an offer, right? And even if it's a different tax year, it's likely, that state's likely going to claw you back. So if there's opportunities for, moves and things like that, that's on the state and local side. We certainly want to consider that earlier than later. And also, planning. So sometimes folks think I'm holding qualified small business stock, and we're seeing a lot of this right now. So you might hear me talk about this more than once during this podcast, but qualified small business stock provides for excluding gain up to the greater of $10 million or 10 times their basis in the stock. So, what they'll come to us at times and say, hey, like I hold C Corp stock. I got a qualified small business. I know I'm not going to have any gain on my $10 million transaction. And maybe they're holding C Corp stock, qualified small business stock, pardon me. But we've got to go through the history. Were they always a C Corp? Did they meet the requirements? Had they held it for X numbers of years? What is the qualified trader business of that company? Does it even qualify at the corporate level for what we call QSBS? And then beyond that, the fun part is what we call stacking, right? So, hey, I have QSBS. I'm going to sell my company for 30 million. Well, if we were involved early enough and we're thinking about that early enough, they can stack what that could mean is gift to relatives, to trusts, find ways to spread that 10 million exemption over and over and over again across various taxpayers in the family, allowing for an even greater than $10 million exclusion. So one thing we see, a kind of a big misstep with is the qualified small business stock where taxpayer thinks they're holding it. They think they're ready to maximize this exclusion, but in fact, it's not really that. It never was QSBS because of how the entity was first formed, or perhaps they've taken it and put it in a partnership and that taints their QSBS. So just things that could be done with stock that taint that treatment. So we see a lot of that. And then other times, companies have issued incentive equity, options, compensation to key employees over the years and not really understanding what does that mean for tax, not just to the company, but to the employees. So we had this transaction once and, company had issued phantom stock to their chief, I think it was chief technology officer. And the time came for the deal. And, all along the CTO thought, I'm going to take part in X% of the proceeds. I'm going to get cap gains on that. When he realized it would actually result in ordinary income and be treated as compensation, he said, no way, I'm not doing this. That's a 17% spread for me. There was some negotiations going on. What the CTO ended up doing, changing all the passwords, saying this deal's not happening until I know I'm getting X amount of proceeds, which is what he counted on, right? Net of 20%. So you never want to hold up a deal because of tax, right? We want to help you get to the finish line as fast as possible. But what that means is let's make sure we understand what our current structure, equity, incentive program means for everybody upon a transaction.
Oh,
So,
that's fun, nasty dude holding up the deal because he doesn't like the tax consequences. I'm
I
sure
mean,
he or she was warned ahead of time that phantom stock means ordinary income on sale. So back to the 10 mil, Nicole. Is that 10 million a qualified small business stock per seller or in aggregate for the company?
no, it's a good question. It's per taxpayer. Taxpayer holding that corporate stock has to be a non-corporate taxpayer. So it could be an S corp, a partnership, an individual. Ultimately, it flows through to that individual, right? But that's the ultimate taxpayer we're talking about. So there's certain ways where you can structure through a partnership, through an S that holds QSBS, but you typically can't put it into another type of entity after that individual is holding it. Because one of the requirements that has to be met is the original issuance. So what that means is I can't buy stock from you, John, and have that be treated as QSBS. I have to have it originally issued to me from the company. And if I go put it in another vehicle, well, then that vehicle doesn't qualify. So coming through the vehicle, it could taint it. So, and another requirement is holding it for 5 years. Now, some creative planning that's available is if I've only held it for 2 years, there's ways I can roll over my proceeds into another QSBS. And that holding period will tack on if I'm able to do that. So just because someone hasn't held it for 5 years, if you've got what we call good QSBS, we like to try to find ways to keep it rolling so we can ultimately take advantage of it on the back end.
And would that NUCO have to be an operating business or can it just be they're holding your money from the sale?
You're like the greatest tax questions. Yeah, no, that's a good question. It would have to be an operating business, but let's say not immediately, right? Let's say I take my proceeds of $10 million, none of which qualify yet because I've held it for 2 years. I start a new C Corp because I'm a serial entrepreneur with great ideas. I put my 10 million into the new C Corp and then I start a business there, right? that C Corp could qualify as long as it meets the requirements, and then I as a shareholder meet the requirements of holding it thereafter. So the time
Very
period
nice.
that the IRS states is substantially all of the period of time that the shareholder has held the stock. It must have qualified as QSBS. So it must have that active trader business, to your point. Substantially all is typically anything over somewhere between 80 and 90%. It's not clearly defined.
Of course not. Why would the IRS ever do that? So mistakes. What are problems that you see sellers frequently have to fix before the buzzer?
Some of the things they typically have to fix are incorrect tax accounting methods. So sometimes they've been, reporting something on one method of accounting, and perhaps they shouldn't have been, couldn't have been, under the Treasury regulation. So going in there, we can help correct that in advance as long as it's far enough out from a transaction. The biggest one, and certainly not my lane, is state and local tax, right? So have they been filing in all of the jurisdictions where they have either economic nexus, a presence? Have they been filing or collecting sales tax in all of the appropriate jurisdictions? Where are their people sitting? So sometimes that guy's working from home in XYZ state. Doesn't count. Well, maybe it does count, right? So we see a lot on the state and local side. But the good news is when it's caught early enough, they can enter into what's called a VDA program, so voluntary disclosure program, where as long as they report to the state or local jurisdiction before they get a notice, they can avoid penalties and sometimes interest and things like that for past and late filings. So it's always good to kind of know what the exposure is. And the key there is until a return is filed in a jurisdiction, the statute of limitations does not begin. So what that means is if a buyer comes in and looks and they don't see a return filed, they know that state can go back pretty much to inception because there's no statute on the limitations for the respective states. Same with the
Does that frequently then cause some sort of holdback on the deal in case there's an audit of the state returns that were, say the 22 return was just filed in 25, the statute starts in 25?
Absolutely. Yeah. So, and sellers don't always want to hold back or an escrow. There was just a situation we had recently where we said, well, can't we just indemnify? And then they can, utilize a holdback. And the seller's like, we don't want to hold back. So we're just going to go back and we're just going to file all these returns. So it really depends on how quickly they want to, close the deal and what the economic outcome they need those net proceeds to be at closing.
Do you still see companies selling that own real estate in the business? And talk to us about maybe some of the issues that could create.
Yeah, no, it's a good question and it depends. And whether or not it's an issue also kind of depends on the structure of the selling company, right? So we've got a company that holds real estate and the buyer just wants to acquire equity. That could be a problem if they don't want the real estate. Because if that real estate has appreciated in value, sometimes depending on the type of entity to get it out, and that would be a corporation, to get it out of the corporation, it would trigger gain at the corporate level unnecessarily on any appreciation in the property. So yeah, that can create a problem. There's ways we can structure around it for the most part, if it's not a C Corp. So S Corp is pretty simple to kind of say, okay, you know what? We can drop this all down and do what's called an F reorganization. I can explain that if you want, but without explaining what it means is that you end up the buyer still acquires the equity, but we can distribute that real estate out to sort of a parent S Corp that doesn't sell. So company gets to sell, the new holdco gets to sell the company, the EIN follows, all the employees follow, all the contracts follow, all that's good. And we were able to distribute up the real estate and just hold it in a different type of entity. Same with a partnership. So partnerships definitely provide a lot more flexibility in what can be distributed out, contributed in, etc. Before a transaction happens. So, it really depends. We see a lot of lease backs, right? Where I'm not going to sell or I'm going to buy and then lease back. So just depends on the buyer and seller and typically the type of property. So sometimes buyer doesn't want property that may come with some environmental issues.
Yeah, for sure. So again, sellers now know from listening that they're not going to sell their stock. It's not like buying IBM. Buyers want to buy assets. So talk to us now about the capital gains versus ordinary income distinction, and how does that give rise to your final tax bill, and what is put in which category?
Yeah, no, it's a good question. So you're right. When there's an actual asset sale, or for tax purposes, we can elect to treat a transaction as what we call a deemed asset sale, whereby it's still a sale of equity for legal purposes, but treated as a tax sale for tax purposes. What happens is that the purchase price must be allocated across 7 different classes of assets, and in a particular order. So we start with cash and accounts receivable, etc. If the seller is on the cash basis of accounting, there could be much more ordinary income depending on the types of assets sitting in the company. So, the type of assets that would generate ordinary income are what we call unrealized receivables. So, if I'm a cash basis taxpayer and I've got receivables that I have not yet realized at the point in time where I sell substantially all the assets of my company, that would result in ordinary income to me. Also, depreciation or any amortization that's been deducted for tax purposes previously must be recaptured at the point in time where the company assets are deemed to be sold. And then another one that really came about with the passing of the 2017 Tax Cuts and Jobs Act is self created intellectual property. So that was actually removed from the definition of a capital asset with the passing of that act. And so what that, yeah, that's fun times. What that can mean is if I think, all I have in my company is this intangible, and this intangible is going to give me cap gains treatment. That may or may not be true, depending on the entity type, depending on how that IP came to be created. So we want to do like a real analysis around that. And if we determine, hey, there is IP here, self-created IP, we likely want to agree on that purchase price allocation methodology, an exact dollar amount, assign it to it right then and there. Because one of the requirements of a deemed asset sale is that the buyer and seller agree on this purchase price allocation methodology in writing. So we always want to see that drafted into the agreement. And then further, when we have something like that, if we're not going to do a valuation, we want to agree on a dollar amount so that post-closing buyers and sellers aren't confused about, what amount of purchase price gets allocated to certain assets that could generate ordinary income. And then thinking of the buy side on that, right? Like typically buyers and sellers are in sort of like complete contradiction on this, because an asset that yields ordinary income to a seller is likely a shorter lived asset to the buyer. So accounts receivable, perhaps, PP&E, that's 5-year life, 7-year life, is more quickly recoverable by a buyer in a deemed asset acquisition, where they get a stepped up basis, they get to write it off, they get to depreciate it, amortize it over time more quickly than they'd be able to recover a basis in stock, let's say, post-transaction, or goodwill, which gets amortized over 15 years. So it is a really important thing to focus on when you're going through the deal, is that purchase price allocation methodology.
Well, if sellers aren't spinning their heads right now, wondering if they've got the right accountant, that they're not paying attention. Well, is there anything you'd like to kind of wrap up with that make sure you get out there before we call it a day?
Yeah, I mean, I would just say that, so often people want to try to cut costs, right? And they just say, look, I'm all set. I've got my longtime attorney. He handles my contracts. I've got my longtime accountant. They're great at preparing my tax return. I think there's just really no substitution for having the folks that do it all day, every day in there, because they just kind of know what to look for. And one, from a risk perspective, of course, but mostly the value add, because we see all the creative stuff that's going on in the marketplace and ways to take advantage of certain types of deductions and ways to plan in advance. And so, just it's always worthy of a conversation, and knowing that they'll work alongside your existing advisors. That's a really nice deal team to go to market with.
Sounds good. You heard it first right here. Well, Nicole, thank you so much for being here today. This has been very enlightening, and I hope that some sellers wake up when they hear this. Thank you again.
Thanks, John.
All right. Well, and to you next time, I don't know what we're going to talk about next time, but I thank you for being here today. If you are on that, we're going to sell in the next few years, make sure that you get your deal team together early, and that's going to include a really top-notch CPA with M&A tax experience, just like Nicole. Thank you, and have a great day.
Thanks for tuning in to Making Sense. If you got something valuable out of today's episode, share it with someone who'll appreciate it. And don't forget to subscribe. One last thing. If you love the show, open your app and give the show a 5-star review. Until next time, thanks for listening to Making Sense.
The views expressed on this podcast represent the opinions of each speaker and are subject to change. These views are not intended as a forecast, a guarantee of future results, investment recommendation, or an offer to buy or sell any securities. The information provided is of a general nature and should not be construed as or used as a substitute for individualized investment, tax, financial, or legal advice or service to any person. Financial planning and investment advisory services are offered through U.S. Financial Advisors, a registered investment advisor. Certain representatives of U.S. Financial Advisors are also registered as representatives of Great Valley Advisor Group, a registered investment advisor. To learn more about Napier Financial, please check us out at napierfinancial.com.